Hello and welcome to the Ken McElroy Show. I'm your host, Danille, here with Ken.
What's up, everyone?
We are getting close to Christmas. We have about a week.
I know, my gosh. I don't know about you guys, but I am behind this year.
I know. We just put up our tree
yesterday,
and I put the ornaments on it last night, and we are going to decorate a little more tonight.
Don't tell anyone.
We have to have the tree in place for when the kids get there.
Fun going to see my mom this week up to Washington.
Yeah, that's going to be a lot of fun.
Yeah. Hopefully you guys are enjoying yourselves and take some time off and relax. These next couple of weeks are good, although I got a closing tomorrow and a new deal I'm trying to put out here by the end of the year. So I do have a couple things going on.
Yeah, it's going to be nice, though. We're going to go to Seattle, see your fam, and then celebrate Christmas here. So today we're going to be talking about why it's cheaper to rent than to own right now. But before we get into that, let's hop into the Twitter questions of the week. Can you ask, do you prioritize the property or the market when investing? Christopher says property always, because it allows me to focus then on who I will manage and what I will manage. The right one will show up in any type of market.
Yeah, I probably would go with market.
Really?
Yeah, and I'll tell you why. By the way, I completely understand. Some of you might not be in my camp. The thing is, I bought really good assets. Like right now, let's just talk about that. Like people have bought pretty well in most cases, maybe overpriced here and there. But we're starting to see signs where the market's changing. Okay, so you might be able to buy a trophy property, trophy asset, whatever it is, in a declining area. So, so that can't happen. The other can happen too, which you can buy maybe not so well. I've seen this happen. So I've seen people overpay, and I'm like, oh my gosh, they're completely overpaying. And the market saves them, So the market, to me, now what defines a market? There's so many things, right? But if a military base is moving in, as an example, then you're going to have more people. That can change a market, or a employer moves in or out, or a military base moves in or out, or a pro sports team, or a stadium, or a freeway realignment, or whatever it is. It doesn't really matter, but I think the market, it could be a sub-market. When you think of market, I think a lot about sub-markets. And then also now, even more so, think of the government policies around, things like rent control and rent caps. So those are market driven, for that particular area. I think I mentioned, I think it was St. Paul, Minnesota had implemented a 3% rent cap on the market. Now, I'm not saying there's affordable problems there, because there obviously is affordability problems, but that does change the market. Mm-hmm. So, if you have a property where you had a value add, 7, 8, 9, 10% rent growth, let's say it was a massive value add, you put a bunch of money into it, but then the market is capping your rent, you're not going to be able to accomplish those, if that makes sense. So anyway, so that's why I think market, to me at least. But mm-hmm. I'd like to see what the next one.
Yeah, what does the next person say? So Michael says finding a balance between the two is crucial. They complement each other. It's challenging to fully grasp one without understanding the context provided by the other.
Yeah, I think that a blended approach is right. And, you have to look at both. I'm not sure. If I was to weight them, though, I would probably weight heavily more toward the market. Because I've, especially on my early days, when people don't really know what they're doing and they think they do, like all of us in the beginning, the market saves our butts. You think about, like I think of people that bought something, 5 years ago, and the market made them look like they were really good investors. That's dangerous. Mm-hmm. In my opinion, it's dangerous when you have the market gives you that much value, I'm sure you think that it's you, but I think it's the market, and I think that with my own stuff.
Right.
But it also giveth and it also taketh away. I've seen that too. So right now it's, I think 20-30% off on commercial at least. So
got it. And then let's go to that third one. Kurt says, really interesting question. For me, it's the market that drives rents, appreciation, etc.
Yeah. I like all these answers actually because it's a heck of a good question.
But you can have a really good property and in the wrong market, it's just...
I've seen it.
Even the sub-markets, I know a girl and her husband, they were going to flip a house. This was kind of when things were... And they bought a house in a not so great, area. And then they wanted to make it the most expensive house in the neighborhood. So they put, all the bells and whistles on it. And they ended up losing money on the deal. But, that's a very small market, but it was the wrong market for that kind of house.
I see it all over the place, especially at the tail end of this boom, I guess, if that's what you want to call it. People buying these tear downs in areas and then over improving and trying to get, 20, 30, 40% more of the houses on each side of them. Mm-hmm. We see that on single family a lot. I think, but I've also seen it, like, you think about some of the best real estate minds in the world. Like, think about who that might be. And I'm not talking about, like, on the internet. I'm talking about, like, the head of real estate for McDonald's. Or the head of real estate for Walmart or Whole Foods. There are people that do nothing but look at, all the analytics for where do they want to put something, right? Because it's a massive investment, let's say. So, and then, I remember there was one in Phoenix that was a Ritz-Carlton, as an example, and didn't make it. Like, how does a huge company like the Ritz-Carlton not make it in a location?
Exactly.
So that's, it can happen. A market can change and it can take down a big brand.
Yep. So before we jump into the topic, I have a couple things. One, I have a webinar tonight with Justin James. He's about 26 years old. He owns 18 properties. For those looking to start or that have maybe 2 or 3 and looking to grow, I think this will be a really great webinar. It's free. You can scan that link to sign up or just go to kenmcelroy.com/ what is it? Webinar. And you can go ahead and sign up that way.
And by the way, this would be a good one for your kids to see too, because I know this young man. He started buying when he was about 21.
Yep.
22 years old or something. So, really good story. Just started with one and got another one, and like probably all of us wish we would have done when we were 21 years old. So this might be an interesting one for you guys to have your kids watch if you have middle-aged kids or even even kids are trying to figure stuff out.
Yeah.
Because it's not a straight path. Let's just put it that way.
Yeah.
There's a lot of ups and downs, and my journey, your journey, and certainly Justin's journey.
But it's definitely doable. And I think
Without
that,
a doubt.
watching him and understanding how he did it, and he didn't come from any kind of privileged background or anything else. He just figured it out.
Yep.
Before we jump into our topic, a lot of people are asking, so I want to address this. Fed rate decreases. They came out, they said we're going to do 4. Potentially. People are wondering, is this going to be 4 points, 6 points? What's your take on it?
Like, listen, guys, so obviously you guys are watching my YouTube videos.
Well, we had Joseph Wang on our podcast, and if you guys don't follow our podcast, it's Real Estate Strategies with Ken McElroy.
Okay, so first of all, I did a prediction saying that the Fed was going to lower rates. Like, what was that, 2 weeks ago? Okay. Secondly, I do have Joseph Wang in my back pocket, by the way. So that that's a competitive edge. But he said 4 times. And if you don't know who he is, you should watch that video. He was on the head of the open markets desk. He was doing billions and billions of dollars a day on the bond side for the Fed. Okay. So, but let's take a look at. I'll just do a summary of what I said. If you take a look at what the Fed did in a year and a half, they raised, if you're doing 25% basis points or quarter point, they raised 20.25% 21 times. That's a lot in 1.5 years. So it's the highest ever. Okay. Now let's take a look at if the Fed reduces rates, do you think that they're going to do that at what pace? So if you take a look at history, you'll see that if the Fed does it, they're going to do a quarter here and a quarter there. They're not going to do a point or a half. They could do a half, I guess, but that's a stretch. So my prediction was that if the Fed lowers rates a quarter point. Now, also don't forget, we're going into a very interesting election year with a lot of the candidates, vying for, and they're going to be all over these issues. So as much as the Fed does not like to be political, in Joseph's own words, they kind of have to be. There's a lot at stake. So I think at the most we're going to see a 1 full point rate reduction. But what does that really mean when 82% of all of America is under 5% mortgages on residential fixed? So, you again, going back to the original thing where I was telling you that it went up so fast in a year and a half, it has to come way down. And it's possible, but I also want you to think of one more thing. When rates come down, it creates more of a bubble, which is exactly what got us into this situation. So the manipulation of rates, or the raising or lowering of rates, is used as a lever to stimulate the economy or contract the economy. So when rates go down, they're saying buy more stuff, whatever it is, cars, TVs or real estate. And so, that in itself is an inflationary move. And so the Fed is still, got a kind of battling inflation. So I think, a lot of it's going to be based on where inflation sits through next year. The election, for sure, there's going to be a lot of pressure on the Fed as we roll into November, based on where things are. So I'm actually happy. Obviously, a lot of the people that bought stuff and have loans that are resetting, this is all good news.
Yeah, and for those, I'd be interested to hear what you guys think about the rate cuts, how much the Fed is going to cut rates next year. So if you could go ahead and comment, that would be kind of interesting.
Yep.
But do you think that if rates go down, that home prices could potentially start to go back up then?
Well, that's kind of the theory behind, if you really look at the reason people started buying homes was because the money was cheap. Mm-hmm. So but I still think it's up there pretty high. It's in the 7s, I guess, now in the 6s, I think. So, it's going to come down. It would be good, but construction's almost at a halt. People are really backing off buying cars right now. Mm-hmm. And the repo man's out there, right? And people are in trouble a bit. So this could help. I don't know if it's going to help on credit card debt, but that would be a nice thing. Mm-hmm. But what's 1 point?
Yeah, 1%'s really, not really.
In a year.
Right, if it's 0.25%. Now, I know Ivan had mentioned, he's heard 4.6 points,
That's a lot. Yeah, but, yeah. I went and looked, actually. You can Google this. How when the Fed lowers rates, how quickly do they lower them? There's no way they're going to go more than a quarter for the first one. And it's possible they raise them or they lower them faster. Possible, I suppose. But even then, think how fast they rose. What are we at? 5.5, something like that, in a year and a half. And everybody's clamoring over what, a 1% reduction. So I just don't.
I think they're clamoring because they're excited, thinking that they're going down, which is good. But then how much is the
I
question?
completely understand, and I get it, and I agree, and I want it. I want all that stuff. But I think that, logically, it just doesn't seem like it's going to move the needle much. Personally, if you're refinancing something, it helps. Obviously, if it settles down some of the banking stuff, it helps. All of that stuff helps. It does. Potentially. But I think the big thing to watch is unemployment.
Mm-hmm.
And we're at 3.7, is it, Jerry? 3.7. The Fed's wants to be at about 4.5, and that's millions of people.
Right.
So that's something really to watch. So you've got potentially, because when an unemployment rate is low, it creates wage growth. In other words, because again, it's just supply and demand. Not that many people looking for work at 3.7. And so what happens is the employers have to stretch, pay more for that employee. That's inflationary. That's wage growth. So the Fed thinks that it should be around 4.5. So you have that, plus you have the potential lowering, which is, I think, potentially is good if it does happen. It's going to be good for us.
Yeah.
I mean, there's no question this is good for the real estate industry. But will it make sellers a little more bullish on their price? The answer is yes. Think about it. Like if there's transactions happening right now in the 7 range, and rates go down, what's going to happen? The mortgage companies are going to jump in, the realtors are going to jump in, and the sellers are going to hold the line. And so now I don't know if it'll make prices go up, but it's certainly if I was in that, if money was cheaper and I was in the middle of selling my house, I would probably say, let's just hold the line here. We're not going to reduce the rate anytime soon.
So I do want to touch on a few questions or comments here that I think are interesting. Florine said, we heard 40% of student loans are already not being paid. Hope the rate cuts are cautious at 1/4 point and test the inflation waters.
Yeah, that's another really good point. That's I think that a lot of those folks are renters. I know we're going to get into that topic, when you're ready, of course, only when you're ready.
And make sure if you're listening, you slam that like button because it really helps us out, and we're not at enough likes right now.
What's your goal?
It depends. I'll tell you later in the show. Every show is different. So Skywalker says, I don't think the Fed will cut rates in the spring. Some Fed chairs and rate cuts were not talked about in the meeting.
Good point. Yeah, that one of the things you can look at, is everybody laughs at me now, is that dot plot. So the dot plot, if you don't know what it is, it basically takes each Fed chairman and assigns a dot to them, and it puts it on this graph, and it shows you where their head is. So what is there? How many is there? 19? 18 or 19 of them. I can't remember. So anyway, it's interesting to watch because you could see kind of where they're all. There are definitely ones that'll be say no rate cuts. There'll be others that say we need a lot. So you got to take a look at the whole picture.
And then I thought it was interesting. Atlas said, Jerome Powell has placed Paul Volcker on a pedestal. I expect he will be asked to retire, having maintained higher for longer. So we'll see.
It's very possible.
The Biden administration doesn't love that. So let's jump into the topic on why renting is cheaper than owning right now. And this is part of the reason that, investments, investors are investing a lot less in the market right now, too. It all kind of goes together. And you talk about how the U.S. is going to be entering a renter nation, you believe. So can you explain what that is?
Sure. So if you go back and look at the administrations, which I've been studying, I go back to, say, Bush and then Obama, let's say, and then was it Trump, right? And then Biden. It doesn't really matter what political affiliation, they all have a different view on housing. So Bush actually created the problem, in my opinion, back in the day, where he said,
"Oh, people are gonna get mad at you for saying
I know. He said everyone needs to own a house. Okay, now on this specific topic, he created the problem. Everyone needs to own a house. American dream, blah blah blah. Just go Google it. You'll see. I went through this. So all of a sudden, he did all kinds of incentives so that people would buy houses, right or wrong. Okay, and there's a point to this. So at that time, housing versus renting, let's say homeownership versus renting, got up to around 68 or 69%, something like that. Going off of memory. Okay, so that means if homeownership is at 69% and the rental market is at 31, then that's obviously a statistic that you should watch. Okay, so what that means is that people are moving from renters into homeowners. Okay, Obama actually got blamed for this because Bush left. And then Obama was kind of in the middle of the whole 2008 stuff. If you guys, I obviously went through this. Okay, so, but really it kind of started by letting people buy houses that couldn't afford them. Okay, and by the way, it wasn't Bush's mistake. It was just administration believed that, and there were all these other things that happened as a result around. Okay, but the point is I want you to stay with me on the percentages. Then the percentages went from 69 to 68 to 67 to 66 to 65. Every 1% back then was 1 million people moving from home ownership to renter. Okay? So this is the way I look at the markets. So you got to look at how the transfer, right? The people are transferring from home ownership to rental. And it's a very complex reason. Obviously, there's a zillion factors. But at the moment, last I looked, I thought we were right around 65, 64% home ownership. And then, of course, the balance in the renters. So it's an important thing to watch because the Wall Street Journal did a really good article, I thought, about 2 weeks ago, maybe 3, that said it's now 52% more expensive to own a home than to rent. So, just Google it, you'll find it. And so what you want to pay attention to is why. And where's it headed? So like if rates go down next year, which is how we started, that's obviously going to lower the mortgage payment, which of course is going to take people. People are usually typically they're trying to go from being a renter to a homeowner. That is just a natural progression. I would say most landlords and most property managers are in denial over that, but it's the truth. Most people go into rent. They start to rent. Some rent forever. Some do not. Some try to move into home ownership because that, at the moment, is a great way to build, your wealth and some equity and things like that. So I think right now, as of just a couple of weeks ago, according to the Wall Street Journal and some of the stuff that we looked at, that's a nationwide poll. It was 50. Let's call it 50% more. It wasn't always that way, but why was it 50% more then? It's because the price of a house plus the price of a mortgage made there it is. Nice, Jerry. Look at you. Oh, wow. So you guys, there it is on the screen, right? So the cost to buy, here's the interesting thing about this chart, though. So the cost to buy was $26.97. The cost to rent was $18.45. Now, that's nationwide. You're going to, in Cleveland, Ohio, your rent's not going to be $18.45. In San Francisco, Portland, Chicago, New York, it's also not going to be or $18.45. So you get the point. But I think what's happening, the other piece that this does not, the Wall Street Journal failed to recognize, is what I consider to be a huge piece. When you buy a home, you have three other big costs. You have mortgage, obviously, is one, but the other three are property tax, which, is 200, 300, 400, 500, 600, 700, whatever a month, depending on where you are. You have insurance, which of course has gone bonkers. And we had almost a 30% increase in insurance. And you have repairs and maintenance. Okay, so you have three huge things that are not included in that chart. So, call it 500, call it 1,000 extra, whatever you want to call it. Can you pull that up again real quick, Jerry? So let's take a look. All right. So you have to add that to that mortgage. So the Wall Street Journal did a good job of starting the discussion by showing the average cost of a home plus the interest rate at the time. Of course, interest rates have changed. The average isn't always the average. In some cases, it's more. In some cases, it's less. But you get the point. But when you rent, you do not have those other three things. Mm-hmm. You do not have repairs and maintenance. That's the landlord. You do not have insurance. That's the landlord. And you do not have the cost of property taxes. That's the landlord. So this delta is actually significantly more than even shown here. So that's when you really take the true cost to buy versus the true cost to rent. It's pretty significant right now. So so going back to what I was originally talking about, as you start to look at these things, if rates were 3%, obviously you're competing against rent. Mm-hmm. If there's 7, there's less people competing against rent. And I think that's probably the simplest way to say it. So just continue to watch this, and rents. If you look at the statistics, there are some you can't find very many markets where the rents have gone negative from the prior year. What you're going to find is them saying rents are down from last year. Well, if you just read that on a surface, you're going to say, oh, rents are down, but they're not. They're decelerating from what they were. So, think of they were 6 or 7 or 8% rent growth to 2 or to 3 or to 1. Either one, it's still positive rent growth. So it's going to be interesting to see what happens. 6 or 7 and 8 to 10% rent growth is not healthy at all. And I'm speaking from a landlord standpoint. That is not good for the tenant. And, there needs to be 1, 2, 3%. We just need to be moving along. Most of my career was that way. But, I think a lot of folks that came out of this last few years believe that 5, 6, 7, 8%, 10% rent growth is normal. It's not.
And I do want to read a YouTube comment. Atlas said landlords pass along the cost of insurance and already build in the cost of repairs. So I'm not sure that I agree.
Well, I like. I think you need to take a look at the rental market. Is not something that a landlord gets to choose what the rent is. I think you got to just start with that. The landlord doesn't get to decide. So now you might have a home where that's written into the lease. It's possible. If a tenant if a tenant signs something like that, then they're contractually obligated. But rents are governed by market conditions. So, I have a property where my property tax payment is $330,000 a year. So think about that. Call that, what is that, $25,000 a month. I can't pass that on. My insurance costs went from $3 million to $4 million this year. So my renewals for next year. So I can't pass another $1 million on just to somebody's rent.
Yeah, you can't just tack it on. There is now if you're under your rental amount that you can charge, then sure you can up it and but if you're charging market rent, right. But I'm saying when the lease expires. But if you're charging market rent, you just can't add it on if your rents aren't at market. Yeah. I know that on my tenants this past year, I haven't raised rents because they're kind of stable. They're paying the max that rent's going for. So
but
I don't want them to move out.
Your costs have gone up.
My costs have gone up.
Yeah,
right.
I know that.
Mm-hmm.
So that's all I'm saying. Like rent rates are a market phenomenon. The landlord can't just say, "Oh, I've got these." Now, on a commercial office building, it's a little different. You have these CPI clauses at the end of the year, Consumer Price Index, and you're able to pass through some of those things. So it could be that you're maybe talking about those. So if you own an office building, let's say, and you have a tenant on the, taking the whole thing, there's something in the lease that says you can pass on some of those increases. Those are hitting now. And that's going to be a very interesting discussion.
Absolutely. And, I was looking at the OECD, and that means the Organization for Economic Cooperation and Development. So basically, there's 39 countries in it, and it's all the countries that you would think of that are kind of similar to the U.S. And they have a 60% homeowner rate overall. The U.S. right now is the highest at 66%. France is at 63, UK is at 62. And these might seem like small differences in percentages to people.
It's a lot.
But for every percentage,
I thought it was about 1 million people last time I looked. It might be more now.
3 million per percentage if there's 300 and some million in the U.S. So, so every time you see a percentage drop, that means 3 million people are no longer homeowners. So it's a big deal.
Take a look at that. Look at this home ownership rate in just after 2000. You can see. So I think that would have been Bush. I would going back to my original comment would have been what about early 2000s, mid 2006, somewhere in there. Yeah, and it got up pretty high, almost to 70, and. Then it just dropped from there. And that actually, believe it or not, keep that graph up, Jerry. That graph right there should tell you that those folks put pressure on the rental market. That's what it should tell you. When you see a graph going down like that. So all of you who are landlords that started buying and, let's say 10 years ago, you got the benefit of all those people falling out of home ownership. Okay, then it started to go up again, and you started to see, of course, the home prices rise, and so that's kind of what happened at the moment. And right now, it's just, I guess, it's kind of plateauing. But if you take a look at what's being built, we're severely undersupplied. There's a big demand, low supply. And there's all kinds of studies on this, and there's all kinds of opinions too. I've seen 1 million, I've seen 3 million, I've seen 5 million. So, but either way, everyone agrees that it's undersupplied, and so that's just population needing housing, and what kind of housing. So they need both. They need single family and they need rentals. So. That's it's going to be interesting over the next couple of years, guys. In the short term, what is there? I think there's 1 million units under construction, kind of rolling out here in the next year to year and a half, something like that. That will all be absorbed. It'll create some rent flatness. It's good. We need supply, okay? But after that, it drops off a cliff. You guys, what you really need to be concerned about, and for some of you guys are in this business a long game, we're going to be in a massive shortage from about mid 25 through 27. Massive. So you want to see some big rent growth and potential housing price growth. That's it. What offsets pricing? Demand and housing. So demand goes down when interest rates go up. But also lack of supply.
Right. And then, so do you anticipate, when you're saying that renting is cheaper than owning right now, do you anticipate that changing anytime soon?
No, I don't.
Yeah.
You guys, as you all know, there's a lot of single family folks that watch, and I think the last I looked, we had like 500,000 listings or something. And I think the average is over 1 million.
Mm-hmm.
So let's call that 40 to 50% of the average. So that's potential supply.
Mm-hmm.
Well, okay, and demand's down for sure because the rates are high. But when rates come down, of course, then the demand goes up. So, will that mean more people will list? It's possible. But we're severely low on demand, on single-family demand. We appear to be overbuilt right now for multifamily and condos and stuff, but that's stuff that got started a while ago. There's not a lot of new starts. Just Google how many starts are in the last 6 months. You're going to see it's dropped off. It's severely dropped off. I just did that. Was it the Beige Report, Jerry? Right? On my last video on YouTube. Every single market. I think there were, how many districts were there? 12. There were 12 different Fed reports all wrapped up into one. So hopefully you guys watched that video. Every single report had a severe drop off in housing starts. So every single one. So, each of these Fed districts, all 12, are reporting significant supply problems and affordability problems. Every single one. So it's coming. You guys, we haven't seen anything yet.
Yeah, absolutely. And don't forget, if you're enjoying this, to hit the like button. We love that. It helps us out. Let's have a goal of 100 likes today.
Finally we get your goal.
Well, it just took a minute. I had to refresh my screen. So,
hey, let's do a little test.
What?
Hey guys, I would love for you guys to get well over this 100.
All right. Let's see if you asking versus me does anything.
We will see.
So, anyways, I'm all flustered now. You completely just threw me for a loop there. So I do want to jump into the questions from our premium members today. But for those of you who are not premium members, make sure to go to kenmcroy.com/join-now. And you can sign up for our inner circle. We do happy hours. You can see more of Ken's lovely face as he delivers content to you more often. And we're doing some lunch and learns and stuff over there as well. It's a great community.
One other thing. I would love to know what you guys want me to talk about, because a lot of these topics that I do, you guys, I don't know if you know, but every single week I'm digging just like you, or reading and trying to figure stuff out. So if I would love to do videos based on your needs as opposed to what I think your needs might be. So.
And Florine commented, I appreciate your beige report. I sent it to GPs in various syndications. So.
Oh,
what was your beige report? Like what?
You got to watch my videos.
Anyways. Well, I think it'd be good if you tell people what it is that are listening right now.
I said what it was earlier, but I'll say it again. It's the Federal Reserve 8 times a year puts out what they call a beige report. And each Fed district does an analysis of what's going on in their district. So essentially, just think of it as divisions doing their own individual report. It's called the Beige Report. It sits up on the Fed's website. You can take a look at what's going on in that district. Then those 8 roll up into the Fed report, which, of course, so it's better to look at the Beige Report, in my opinion, because you can take a look at all 8 or 12, and it comes out 8 times a year.
Yep, absolutely. All right, we're going to jump into the questions. Also, my YouTubers, make sure you ask some questions, and I'll get to a couple of them. So Joe P. from the Inner Circle is asking, is a 4% return enough to return on cash to do a deal? After raising rents next year, maybe I can get to 5%.
So that's tight. I did read the question, and it looked to me like you were making $900 a month in cash flow. Jerry, can you put that question up? Maybe. Oh, you can. So that was confusing a little bit. Where I think it said that he has a cash flow of $900 a month. He's trying to buy a bank property, if I remember. It's about $350,000. So, see, 9 a month is, or 900 a month is what, let's call it 10 grand for the year, 10.8, I think. So 4% would be, gosh, that means he's putting a lot down, right? So, that's an unlevered cash on cash. I would take a look at maybe a strategy would be, there's nothing wrong with, if that is truly the number, it's going to be, if it might be a little bit more if you can lever it. In other words, even though rates you might be 6, let's say, you can pull that money out tax free. It's a refi, cash out refi, and do it again, and you might be able to bump your number. Also, it's a little tight though if a couple things go wrong,
Yeah, it can be really tight for something that expensive.
But there's nothing wrong with an all cash because don't forget, your tenant's paying everything. So $900 a month is a lot of cash flow.
Yeah.
Did you see that? So I thought that was an interesting question.
So Afro is asking, I'm 16 and new to real estate. Is there any way I should prepare for the future or any books I should read? I've already read the ABCs of real estate.
Yes, gosh, thank you. 16 years old. First of all, I know I'm not trying to take you back at all, but I think you should crank out that cash flow game. Believe it or not, I think the cash flow game is a really, really good thing. It's not necessarily a real estate game, but it's a cash flow game. And what happens with real estate is there's real estate deals on the board, of course, but it's fun to play, and you also get to look at all kinds of deals, and you get to see the difference between stocks and buying businesses and buying real estate. But the best thing is there's a financial statement and a balance sheet there that you have to fill out. And when you do that, you start to see passive income and how all that works. So I think that's a really good base for you. The other thing is I'm a big fan of the most education that you get with your real estate license, even if you don't use it. So I've had many. I had Nevada, Washington, and Arizona. I had broker's licenses in those. I don't anymore. I let them lapse. But when you go through those programs, first of all, you're typically being taught by real teachers. So like my son just went through this program, and I'm like, what did you like the most? He's like, the teachers. They're like real people out doing real stuff. So, but you learn things like zoning and water rights and things like that you might not pick up in a book because it might be a very small part of a chapter. So those are the two moves I would make. The books, obviously keep devouring the books. How about you? What would you?
You got to watch who you're hanging with. That's the number one thing. I'm assuming because you're on here and you're listening that you're hanging with people doing the same things, but more opportunities will come to you as you make connections that are also doing big things or wanting to do big things.
Yeah. The other thing is you can, it's a good time for you to start looking for a mentor or coach locally. And
not one you pay a bunch of money to.
You don't need to pay for it at all, actually. I don't think. I think what you need is just don't find somebody who's a realtor. Find I shouldn't say it. Let me backtrack on that. Look for somebody who buys investment real estate. You've got realtors and real estate agents. By the way, I don't know if you saw the numbers, but they're like dropping off like crazy.
Yeah, I bet.
The number of people letting their licenses go from this last little run. But you want to find there are realtors that are transactional. Like we had a realtor on, and she I was talking to her at the gym the other day, and she's like, "Oh, my Airbnb, I'm breaking it down. I'm doing a long-term rental, and she's got renters and she's got Airbnbs, and so that's the kind of realtor you want. Mm-hmm. You want somebody who's looking at the market, not just trying to sell you a home for a commission. Mm-hmm. You want somebody who's actually looking at them for, more of a business because." Generating passive income, or maybe even it can be a capital gain even, but that's I think the kind you want to be mentored by. Exactly.
Larry from the Inner Circle is asking, are REITs, real estate investment trusts, still a good investment in today's market? And if so, how and where do I get started in investing in one?
So let me back up.
You don't love REITs.
Well, there's a couple things. REITs are called real estate investment trusts, okay? So here's the thing. Like, let's say this is a REIT here, this glass. You got to pay attention to what it's filled with. It could be filled with industrial properties. It could be filled with malls. It could be filled with condos. It could be filled with retail. It could be filled with office buildings. It could be filled with multifamily. So there's multifamily REITs. And then from there, it could be a multifamily REIT that's buying downtown urban core properties. It could be a multifamily REIT in Florida that just is doing Class A. It could be a multifamily REIT that buys value adds. So the point is, it's not necessarily just investing into a REIT. It's what are they investing in? So you got to dig a little bit deeper. The REIT is simply a vehicle to help them have the money.
Right.
And so you got to take a look at what's going on with the actual assets. The one thing I don't like necessarily about REITs is the depreciation piece. Like when you buy a piece of real estate, in my opinion, one of the biggest reasons is cash flow, of course, but another very big reason is the tax advantages. And so, when you're at the REIT level, I don't believe that you get to participate in those.
Right. And that is the disadvantage.
That's a huge, huge, huge disadvantage. I mean, what you want is, I have friends that are very good friends that were making a lot of money in other businesses, and I told them to go buy their own building and buy some rental housing and things like that. And now that the appreciation from those offset their a big chunk of their income. So real estate is a strategy not just for cash flow, but also for offsetting tax. So legally, and I think that. So that's the one thing I don't necessarily like about REITs. You're just basically in the stock market.
Right, just through real estate. Esteban is asking, and I don't know if this is a question you know or not. If I make a withdrawal from my annuity to buy a house in December, but I don't close on the property until February, do I include the income from the withdrawal on my tax return this year or next year?
That's a tax question, but I can tell you, if you withdraw something out of some kind of plan, it's going to be at that point, right? So I don't think, I don't believe the IRS cares when you buy something. It's So I don't know what kind of vehicle it is. You call it an annuity, but I know at whatever day you withdraw money from something that's, let's say, tax deferred or has some kind of penalty on it, like a 401k or something, you will incur it in that period, whatever that is. They don't really care what you do with the money.
Yep. And check with your accountant just to double check.
Yeah.
Steven is saying if you invest in a REIT on the stock market, some of the dividends are taxed as ordinary income rather than capital gains like other dividend stocks.
Another really good point. Thanks for bringing that up. That's a big deal.
Can you explain that a little bit?
Ordinary income is taxed higher than capital gain. So I think capital gain right now is at 20. Let's just say 20. I could be wrong. I'll get corrected either way, which I love. But then or your ordinary income, think about what your ordinary income rate is. It's based on what you make. So it could be in the 30s probably. And for me, it's into the 40s. So that's the difference. So you get that's a really, really good point.
Judson is asking, and this is a little confusing of a question. He's from our inner circle. When is a good time to expire a lease and find a new tenant?
Well,
we can't expire the lease until the lease is over.
Yeah. So I let me answer it the way I think we would do it. So in a market that's going through turbulence, we like longer term leases. So think about it. It makes a complete amount of sense. Like if there's a bunch of units being built in the area, or maybe an employer's leaving the area, there's just a demand in the area that's gone down. Or how would you know that if a vacancy in a property is there more than 30 days, maybe 30, 60, 90 days? That would be an area that we would want longer term leases. You do not want a lot of turnover during that period of time. So what does that mean? That could be a year. I know in some cases people do longer than that. Personally, we like to do a year. And then now let's go the other direction. Let's say you're in a market where there's rarely a vacancy. Literally, the minute you put something on, let's say even Craigslist or Facebook, it's rented the next day, or it's high in demand. So again, that's a people issue, not how smart we are. So there's a lot of people looking for a vacancy. On that particular one, you might want to have a shorter term lease, because you're going to be able to get rent increases on renewal. In other words, when there's a lot of demand during vacancy, then you as a landlord have a little more control over where the rent can go, although you're not going to be able to go over the market, and there is a market ceiling at some point. And so that's the difference. And so, but the lease expires when the lease expires. I've bought in plenty of properties where they've been month to month. That means they're expired. And I bought in plenty where they're, longer term. So.
Awesome. Well, I wanted to touch on a few things. One, we're over 100 likes, thanks to you asking versus me.
Terry, how was that?
Apparently, you're more effective, so I'm going to have you start asking people to hit the like button.
They'll get liked fatigue. I appreciate you guys. Thank you.
And secondly, a lot of people are asking for you to start doing some response videos, and they had mentioned certain videos, so we'll look into doing that.
Okay.
I know you're nice and you hate doing response videos, but I think maybe in this market,
I know. I don't like to trash anybody. Let them do their thing, but maybe I will. I'll take a look.
I'll have to wait till you're in a spicy mood. So,
well, I do get fired up at some of these people.
You do, I know.
I just don't put it out on the internet.
I know. You bite your tongue.
I do.
Awesome. Well, thank you guys for checking it out. Make sure you check out my webinar tonight at 5 o'clock Arizona time. Just scan that link there, or to go to kenmcelroy.com/webinars, plural. Justin James is going to be a great guest.
Yes, and Merry Christmas.
Yeah, and
guys,
happy
next
you
month.
have to be PC. Happy holidays.
Oh, happy holidays. That is very true. I do.
All right. Have a good one, guys.
See you guys.